Welcome to a mid-month macro market update, given the pervasive spread of the COVID-19 virus. Now, you'll remember that we had thought 2020 would see a mild recession, with equity markets falling around 20%, stressing the fact that the global economy was very vulnerable with a great deal of dependencies and imbalances. Now, we didn't, of course, predict COVID-19, and as a result of that, we have to change significantly both our macro view as well as the outlook for financial markets. Now, on the macro side, we had expected global growth to be around 2%, much below consensus, but even that has to be cut dramatically, and we now think 2020 will see growth close to or even a bit below zero. And of course, that comes with Q2 of this year seeing a profound contraction at double-digit levels for most of the major economies, before we think there'll be a recovery in Q3 and Q4 of this year, given the policy measures that are now being implemented. Now, from a market perspective, although equities are down over 30% and credit spreads have spiked higher, we think we're not quite there yet. Certainly based on some historic valuations, we think that the bottoming process will take a little bit longer. So what do we need to see to be more confident of that bottoming process? One, we need to see profound monetary measures taken, and indeed that's happened. We've seen interest rates being cut to the lower bound, and we've seen really huge quantities of quantitative easing asset purchases now underway. On the second front, in times of stress like this, we need to see a buyer and lender of last resort, and that needs to be governments. And indeed, we've now seen huge numbers being pledged, but until we actually see the policy implemented, getting the money to the people and to companies, that box still is not quite checked yet, although clearly encouraging signs there. And to the last point that we need to see comes to the virus itself. We need to see stabilization, containment, signs that growth rates have peaked. And again, we're not quite there yet. And we need to see that really to understand the economic impact and the financial market impact in terms of earnings and what that means for valuations. However, we're getting to that stage slowly, but one thing that's worth stressing, of course, is not panicking. On an economic terms, it's easy to extrapolate some very bad numbers coming out. We suggest we don't do that. We look through it and we look at the fundamentals and we look at the mitigating actions that are being taken. And equally, from an equity perspective and credit perspective, we don't want to extrapolate some of these run for the exits that some investors are doing. Yes, we need to be sensible and constructive on that, but we know historically times of panic becoming pro-cyclical is not a good investment for the longer term. So let's be pragmatic and realistic, but again, not panicking. Now, you can read this in our weekly publication that's out today, Monday, and of course in all our publications we'll go into more detail around this, available on zurich.com/MSME.